Good morning, my name's James Garish and welcome to today's income note. It is Wednesday the 9th of October. Today's note's going to be a little bit different. We're doing a recorded version answering specific subscriber questions on listed investment companies, LICs, that we've come across. So I've got a pile of questions to get through on today's recording. Before I do, just a quick reminder that any advice provided in this video is general advice at best, and you should consult a financial professional before taking any information on board. I stress that it's general information at best. So I'm going to crack on and get into subscriber questions that we've got on the listed investment company area of the market. It's a fairly interesting area of the market. We get a lot of questions coming through the information pipe here at Market Matters on specific listed investment companies, why specific things are playing out. Just to take a step back, a listed investment company is a closed-end fund, so it's a company that manages a bunch of listed shares, or shares I should say, because some do unlisted shares as well. It gives holders of that access to professional management, etc., in a listed vehicle. A listed investment company has more discretion around when they pay distributions and dividends, etc., to the shareholders of that listed investment company. There's a new version of listed investment trust which they need to pass through the distributions on an annual basis. So that's the main difference in terms of an LIC and an LIT. But in today's recording, we'll call them sort of one and the same, but there are some slight differences in terms of the tax consequences between an LIC and an LIT. I'll crack on. First question is from Bruce. I don't understand why large cap LIC share price dividend payouts don't appreciate more in line with the market. And I understand LICs are all different investment philosophies, can trade at discounts and premiums to NTA. This is a reoccurring theme, the issue around discount and premium to NTA. So we're going to spend a bit of time on that today. Bruce has used an example of BKI over the course of the last 5 years. So I've got BKI on the screen there. It gives you some insight into what BKI does. The capital appreciation is virtually nil over the last 5 years, which is $1.56 to $1.60. In comparison, the XOA is appreciated by 27%. Why wouldn't the NTA of a large cap LIC appreciate more in line with the underlying investments? Similarly, the dividend per share has gone virtually nowhere, from 6.94 cents to 7.32 cents per share over the same period. So it's a pretty easy question. So BKI, just to give you an idea, is trading around about NTA at this stage. It's a little bit below their NTA. So their NTA sits at 163 and they're trading at 162. So and then NTA, or net asset value, so NTA stands for net tangible assets, NAV stands for net asset value. That's the value of the underlying shares in the portfolio that they hold. So if you think about it, a company should trade in line with the value of its assets. Your portfolio that you've got sitting on CommSec is worth the amount that the shares are worth in that portfolio. Listed investment companies can trade at a premium or discount for a whole host of reasons. There's a couple that are coming up that are trading on big discounts, which will give some more insight into why things trade at a discount. BKI, ASX Top 300 manager, fairly vanilla. They trade more or less in line with their net asset value. So just to take a step back on why they haven't appreciated as much as the market, there's a good feature on Bloomberg which looks at total return analysis. So we're talking over the last 5 years, Bruce. So the orange line at the top looks at dividends, includes dividends in the price of BKI. So if you think about the market, the accumulation index, or its benchmark, for this LIC assumes the reinvestments of dividends at all times. So when you reinvest dividends, you're going to have obviously better price performance. So in terms of BKI, if we assume dividends were reinvested over that 5 year period, then it should be worth $2 $1.27 today versus $1.62.5 today. So if that's assuming the reinvestment of dividends, and that equates to an annual gain of 7.61%. So you multiply that by 5 there, Bruce, and you get sort of outperformance of the market where you've suggested 27%. Just to give you an idea, I don't have the numbers of the. I think this LIC would use the ASX 300 as their benchmark because they are an ASX 300 LIC. Just to give you an idea, the ASX 200 accumulation index has added 6.4% per annum over that period. So, there has been some marginal outperformance in terms of BKI when we assume the reinvestment of dividends. So the performance on BKI is not, it's not overly great, but it's not overly poor either. In terms of that one. Next question from Rob. Hi, I'm a reasonably new member looking to gradually align my stocks with Market Matters portfolios. I have WAM in my existing portfolios. What's your thoughts on that stock? So WAM's an interesting one because it's been it traditionally trades at a pretty decent premium to NTA, and the reason for that is around marketing. We have a really good marketing team that they market this thing well. It's also been going for a very long time, so it's got some really loyal subscriber shareholders. So I'll just get WAM up there. And my view on WAM, it's I wrote an article for the income report a couple of probably 18 months or so ago now, why I'd be selling WAM at these current levels, and it's actually struggled for a while now, ma'am. I'll go back and give you a look at the share price performance or comparative returns of WAM versus the ASX 300 over some different time frames. So, WAM had a really good track record early on in its piece. They had a chief investment officer, Chris Stott, who is a bloke about my age who was very good. He's about to go and start his own fund very shortly. But since then, they broke each different WAM portfolio up, and they had different lead portfolio managers. Jeff Wilson stepped back into the fray as chief investment officer. So they had a bit of a change of structure and a change of personnel. Since then, performance has really struggled. WAM has been negative, the market, while the market's been rallied, etc., etc. But to give you an idea around what I'll do with WAM, I don't understand holding a listed investment company at a premium to NTA. So if I go back and look at WAM right now, WAM's trading at that's my Bloomberg Messenger going off. WAM's trading at a 22.7% premium to the value of its underlying shares. Now, why is this the case? Well, firstly, the simple concept of the market is for every buyer there's a seller, for every seller there's a buyer. So when a buyer matches up with a seller, shares transact. So if you've got someone willing to pay above NTA or the value of the assets, then a trade's going to happen at that point. Why would someone pay up above the value of the underlying assets? Because they're backing the investment team. I guess it's like if I look at Magellan, for instance, Magellan Financial Group, the fund manager, the head company. So why does that trade on such a big premium to some of the other fund managers out there? Because the market believes in Magellan. They believe that they can deliver above average returns. They believe they can deliver above average fund flow, and they believe that they can justify paying 25, 30 times earnings for MFG versus something like a Janus at the moment, which is trading on sort of 8, 9 times earnings. There's not a lot of optimism built in terms of the Janus share price, and that can happen in the LIC space. So the market is typically optimistic on WAM. They've got it's proven to be a really strong performer over time. So when you're allocating capital, a lot of financial planning businesses, etc., allocate into listed investment companies. It's simply within models, and they go and allocate it no matter what the price of the security relative to NTA is. So, I think if you'd ask Jeff Wilson, I don't think he'd be buying WAM at a 22% premium to the value of the assets. and I wouldn't be either. So I'm not a buyer of WAM. So I'm quite negative WAM given the premium to the NTA. If you think about the other WAM products, so I've just been looking at some of the others that are trading at now a discount to NTA. So if I look at the new WAM Global product, this is actually trading at a pretty steep discount to NTA at the moment. So the discount, 12% discount to market. So it's a reasonably new listed investment company from WAM. It hasn't enjoyed great returns since listing, but it's trading at a pretty steep discount to the value of its assets, and that's based on its performance since listing, and the price of the LIC is down 4% on an annual basis. So I'm not a buyer of WAM here, Bruce. So Rob. So that leaves me to be a seller of it. Okay, so Jason writes, I've been a subscriber for 2 years and really enjoy the publication. I haven't written previously, but I was hoping to get your view on CDM Cadence. Purchased 2 years ago in line with a recommendation from my broker. Its poor performance during what has been a bull market is nothing short of ridiculous. My question is specific about his ongoing buyback scheme and whether it will reflect positively on the stock in the future. If at all, whether it's is this a short-term remedy to prevent the price going even lower, or has this practice some real purpose moving forward? Jason, you're not wrong. Cadence has been an absolute disaster over the last couple of years. I'll get the ticker up there. So Cadence CDM. Okay, so if you look at comparative performance, just to give you an idea, the premium, the discount at the moment, it's 9% to its net asset value. So the fund has a net asset value last updated here on Bloomberg on the 27th of the 9th. Iris might have a quicker update, but we'll run off the Bloomberg for now. This is sort of more like a hedge fund strategy that does go long and short the market. They have, we had Carl Siegling in, who is who runs Cadence Capital. He's also their major shareholder. So he has, just to give you an idea, Carl Siegling's got nearly 23 million shares in CDM. So that's the positive side. A manager that is backing themselves, I like. Sort of they're eating their own cooking. So there's no one hurting more out there than Carl at this point in time. But I think a couple of things have gone wrong at Cadence. So Cadence has always been, and I've known this LIC for quite a long time. They've always put themselves up as managers that had a disciplined entry and exit strategy. They used stop losses. They used, they had a technical overview similar to what Market Matters does. So looks at a technical overlay of the market, applies some fundamental filters and their own macro views around the landscape of what's value and what's not value at any point in time, and then actively manage a portfolio of stocks. The issue with Cadence is they got into some large positions. One of those hasn't been updated there. So in terms of Cadence, they go into some large positions. Macquarie's a large position for them, but the other stock that was a large position for them was known as Melbourne IT. So Melbourne IT changed there to code ARQ. So ARQ has been an absolute disaster, and they had a really big portfolio holding in it. I'll get you a chart of ARQ. There's just a price chart of Cadence on the screen there to show what I'm talking about in terms of the poor performance over the last 5 years or so. It's plumbed new lows south of 80 cents. So ARQ is was their largest holding in the fund. So this is the ex-Melbourne IT, ARQ it is, not ARG. Art Group. So that gives you some understanding of why their performance has been so poor. At this point in time, I think from memory, they had about 12, 13, 14% of the fund in ARQ. Now, they have a limit on what size positions they can hold. It's 5% on the initial purchase within that fund, but as stocks go up, which ARQ did, this position got larger. They didn't trim it back to manage risk, etc., and they clearly didn't use any of their stop loss parameters in this stock. So that's what's really hurt Cadence performance over a long period of time. Let me just get that off so I can crack back on to looking at, let's go down there. All right, so Cadence. So what do you do about it? They have come out and Carl has been buying stock. They've also launched a buyback, and whether or not that will be enough to restore confidence. One of the things in the market, and this is what I'm really conscious of all the time, is delivering what you say you're going to deliver. So if you say that you're going to have and here I quote on there, in terms of their investment style and process in their marketing that they put out. The manager uses both fundamental and technical trend analysis in making investment decisions and has a very disciplined entry and exit strategy. So clearly they don't. So when they don't live up to, when they don't have, if they don't show that they walk the talk, do what they say they're going to do, then the market doesn't want to buy them, and that's true with Cadence at the moment. It might be a really good value play at the moment if you believe in the longer term performance of Carl Siegling, etc. He's a pretty smart guy, but he's obviously got it wrong for a fairly long time in terms of this. He's backing this LIC. So look, it's really been a disaster. Owners of the LIC, so managers of the LIC, like Carl, buying stock is going to be a positive. If they do an on-market buyback, it's going to be positive. We've got a question on ALF and what they did. So I'll crack on to that. And this is probably the extreme. It's one thing for managers of the LIC to go out there and buy their own stock in small quantities. You often see 10 grand passes on a daily basis. It's there to appease market confidence or create market confidence, but it's not it's a little, I wrote about last week, it's a bit of a pitching wedge when you could be going out there and using your one wood. And I think the Australian Leaders Fund has been, although this has been a pretty poor investment over time, their returns have been poor. This is another one that's trading at like an 18% discount to the market. This chart on the screen there compares their benchmark. So that's the All Ordinaries index on an accumulation basis here, and this is the price of ALF. So that undercooks it a little bit because it doesn't include dividends, but still you can still see how how poor this performance is. If I go back and look at total return analysis. If I go back and look at total return analysis, then it's still a very poor return. So let's put that on a 5-year basis. Yeah, so incredibly poor. It's all in the red there. So ALF, though, they've done a pretty interesting thing. They've come out and said that we will give the opportunity for each individual shareholder to tender 20% of their shares into a buyback that will buy back at NTA. So the company will effectively liquidate. If they get 20% tendering in, they will liquidate 20% of their portfolio at NTA. So they'll sell those shares at $1.04, which is their NTA at the last published point that I have. Sorry, net asset value is $1.18 at the last published that I have versus the 96 share price. So they will liquidate their portfolio and return those funds to shares. Now, up to $45 million. So why doesn't everyone do this? Because an LIC then effectively loses those funds that they're managing. So, they would come out and say that it reduces liquidity of the LIC, and there's all these negative things about doing that. The cynic in me would just say that they're going to lose funds under management. They're going to lose the fees that they're going to, that they're paid to manage those funds under management. They're giving back, a large portion of their funds that they manage, and therefore they're going to be earning less in terms of the fees that they get paid. So I applaud Australian Leaders Fund for doing it. I think more should do it, because I think there is becoming, it's pretty. The LIC sector is getting a pretty big discount to LICs. If I look across the universe. At the moment, all LICs are trading at, or the majority of LICs are trading at a bigger discount than they have traditionally. I do have a report on this, but it does show that there's meaningful discounts being applied to LICs, and even the premiums and discounts that have been historically the norm have come in. So, as in, if things have traditionally traded at a premium, that premium is less, and those that have been trading at a discount, that discount has become a little bit more. But we'll move on. We're getting a little bit bogged down in intricacies of this. So cadence, it might help. So it can't do any harm, Carl and the company buying back stock, but it needs to be in decent lines, and it needs overall performance needs to improve. So that's money tracks performance, and performance needs to improve. Okay, so next question is from Rose. I own CBG. But they are no longer appearing. So that's an easy one, Rose, because they've done basically they've been bought out by Climb. So Climb has taken them over. So CAM have taken over CBC. So they've done, it's actually not a bad deal for CBC holders. So CBC has been a pretty, it's been an average performing LIC. It was subpar. They had a market cap of sort of 26 million. So that's a small LIC. You don't have a lot of liquidity in that. Ronnie Chalmers, I think, was the guy behind running that. So to give you an idea, so it structures this, and I looked at this for someone about a month or so ago. So these figures might be a little bit old, but you get in that as part of the deal. Basically, you get for every CBG Capital share, and their ticker for that is CBC. So on the 26th of the 9th, it was acquired by CAM. Okay, cool. Okay, so you got 0.8441 CAM shares for every share you hold in CBC. So at the time, that was valued at about 76 cents worth of CAM stock. And then you also got 0.27 of a listed convertible note. So CAM have these listed convertible notes, and that had a value of 27.4 cents. So basically, the combined value was 103.7 at the time. So basically, they were, these CBC were trading at a big discount to the value of their underlying assets. CAM have come along and structured a deal that allowed CBC shareholders to get a net asset value of them, but in CAM stock and also CAM listed convertible notes. The notes pay a distribution, a quarterly coupon of 6.25%. They're listed under code CAMG. So it's not a bad. It wasn't a bad deal for CBC stock. So you should see they're both listed. So you'll see CAM shares in your portfolio, and you'll see CAMG shares in your portfolio. So you'll get more value than if you were simply selling those CBC on market. Alan asks about LSF. So L1 Capital. This has been another poor performer on the market. These guys came to market with a lot of fanfare when they listed. They raised a huge amount of money. They raised about $101.33 billion to be precise. They were going to raise 500. They got so much demand that they upticked it to about 1.33 billion. It's not bad when you're getting 1.4% per annum management fee, plus you're getting 20% of any performance you're getting. So it's a pretty it's a pretty edgy performance fee structure in terms of LSF, and their performance has been extremely poor. It trades now at 11% discount to the market. That discount was 16% as at the 30th of June. So the discount has come in a little bit. There's a couple of guys behind it who have agreed to buy a bunch of stock to try and get that discount up to scratch, but or close that discount to NTA. At the end of the day, it's a if I overlay the ASX 200. The performance data is not coming up here because it's only been listed for a pretty short term, but it is. That shows the ASX 200 there versus what they've done since performance. So there's been massive outperformance. So the LIC is sort of underperformed by 40% versus the market over that time. So this is a long short fund. They go a long stock, so they buy stock, and they also go short stock to benefit if shares decline. The issue with that is that if your shorts go up and your longs go down, you get hit on two sides of the ledger, and that's what's happened in terms of LSF. They've had some incredibly poor calls. They've had some incredibly poor performance. So it comes down to backing management around what they can do, and this is a very, very big LIC. So it's a very big liquid LIC. But the discount is a big one. So if I go back and have a look at the discount at this point in time, the discount's 11%. It was trading at a discount greater than that. So the buyback that they've launched is probably working in terms of LSF. And I'm reluctant to sell anything in terms of it's such a big discount to the value of their underlying assets. I think they're very much incentivized. These guys had a really good track record when they brought this to market. They're wealthy guys. They've been very successful fund managers over many years. It would be embarrassing for them to see this LIC trade the way it has traded. So this is for all out to see. Fund managers are very there's reputation is really important in our business. So I think they would be wanting to do everything they possibly can to A, improve performance of the underlying portfolio, and then B, contend with the discount. But ultimately, performance over longer periods of time will close that discount. If the market becomes content with performance and the predictability of that performance, then that gap to NTA will close. There was another question on WAM leaders, and this is from Simon. I'm struggling to understand why WAM leaders is trading at a discount to its NTA. None of the other Wilson LICs trade at such a discount, and a large cap stock that's liquid, large cap LIC that is liquid, etc. So thanks for that. There are other WAM LICs that are trading at a discount, but I get your point here around WAM leaders. So if I look at WAM leaders as at the 30th of June, it was trading at 11% discount. That may have closed. Some of these discounts have started to close in recent times. So the last data I've got through Bloomberg is on the 30th of August. So and it was trading at $1.19. Sorry, that's as of yesterday. It's trading at $1.19 versus its net asset value of $1.25. So it's trading at a 4% discount. This is a reasonably big. They raised nearly $1 billion for this LIC. The performance hasn't been overly great since listing. So it's a fairly vanilla, as the name would suggest, Leaders Limited. They launched this at a really good time. Wilson Asset Management, they tend to do that. They're pretty good in terms of when they launch things because they've got a feeling for the market. They have been good at doing this, but in terms of the this actual fund that has underperformed the market pretty meaningfully over that time. So that's the ASX 200 and the WAM leaders over that time. So underperformance has been the major catalyst or the major reason for such significant such a discount to the NTA. So at the end of the day, fund managers are you're paid a fee to manage money better than the market. So to give you an idea, the WAM leaders charge a management fee of 1%, plus they charge a performance fee of 20% of excess performance over the ASX 200 accumulation index. So if I look at the performance since listing, it doesn't, obviously the performance fee is not going to kick in, but for a fairly vanilla product, they say they're going to be active around their allocations, but when assets exceed, they've got 993 million in total assets in this fund. That makes it hard to move around the market. We manage 10%, 15% of that amount of money. And moving around the market can still be, you've still got to think about liquidity. You've still got to think about the stocks that you're putting in the portfolio. And there still is a price for liquidity. So I don't think you can move around the market as easily as, with $1 billion under management. WAM have also got, I think they're up to $3.5 billion from last look. So that's a meaningful amount of money they're moving around the market. So, if you think about when they first launched and they had small amounts of money, with small amounts of money, you can be more nimble around what you do in the market. And that's where you print your strong performance figures. When you get bigger, you get more aligned, or you should get more aligned with the index. A lot of these funds have started to underperform the index. Carol writes, Master Income Trust, you have it in the Market Matters income portfolio. I'd like to know a little bit more about this listed investment company. It's a listed investment trust. Would you be adding to it at this point in time? So, we do have the MXT in the Market Matters income portfolio. So it's called the Master Income Trust. As the name suggests, it's a listed trust. It basically focuses on direct lending in private debt markets. So they go and sit alongside banks and provide businesses, corporates with finance solutions. Obviously, those corporates pay a interest rate. There's the risk that the corporate defaults on their loan, etc. But they have a heap of different loans to offset that specific individual company risk that they take on. So they do that via diversification. They also do that by the level of exposure they have to each particular loan, and they also mitigate the threat of losing money by having security over assets. So they sit higher up the capital structure. They sit alongside banks in sort of secured lending markets. So it's a really interesting LIC, and LIT, I should say. And these guys were the first of the party coming out and doing one for that invested in different assets. There's been a whole heap of them come out recently. Those that Metrics have another one called the Metrics Opportunities Trust, which is a higher risk, higher return sort of version of this. MXT for this one, they target a return of the RBA cash rate plus 3.25%. They've delivered that. This is an LIC that trades at a premium to their NTA. So the last net asset value was printed at $2, and they're trading at $2.07. So, why would you go out there and buy these right now at a premium to their NTA? I'd probably be reluctant to do that. They may come out with a new issue. They typically, and they've done this a couple of times since listing. We were involved in the listing of this LIT, and we've been involved in some of the capital raisings thereafter. They often come out and issue new units in the trust to increase their footprint. and they do that at NTA. They said whenever they raise money, it will be at NTA or net asset value. So right now, if they were to raise money, they'd come out and raise it at $2, and there would be an opportunity for existing holders to go in and buy some more, but there'd also be a shortfall facility where new money can come into it. So if we hold this in our Market Matters SMA, so the Market Matters has two SMAs, one that tracks or is aligned with the Platinum portfolio on the website, and one that's aligned with the income portfolio on the website. Both have done pretty well over the last 12 months. A free plug there. So we hold this in the SMA, so as new money goes into that SMA, the separately managed account, we will be buying this on market, and you buy it at 207. But ideally, if you're external to that, then it would be worth buying as close to NTA or NAV as you can get it. I've got a couple of other questions. I'm just conscious of time in terms of we're 35 minutes into the recording. So the other questions were around Milton, whether that's a reasonable LIC to be involved in. Yeah, it's been around forever. They listed on the ASX in sort of, I think it was the 50s. They do what they said they're going to do. So unlike some of the other LICs out there, Milton have done what they said they're going to do. Management expenses are incredibly low. They charge 14 basis points and they don't have a performance fee. So effectively, it's like holding an ETF, Milton, I would say, and management fees. You can get a cheaper ETF than this, but comparative performance has been reasonable. It's a $2 billion LIC. You can clearly see that they have started to. There has been a level of underperformance in recent times, but if we go total return analysis, these guys stack up pretty well from memory over a long period of time. So they've done, if over the last 5 years, they've done an equivalent of 9.6% if you had reinvested all of your dividends in Milton. Meredith asks, I've not seen many LICs trading at high discounts to NTA before. I haven't seen so many LICs trading at such big discounts to NTA before. Am I correct that this is a current trend, and if so, why is this? In many cases, this is despite good performances measured by rising NTA and dividends paid. A share price is likely to trend toward NTA and therefore represent good value in the future. Thanks for your insights. Okay, so that is it's a good question. So they are trading at significant discounts. The ones that are performing well have a smaller discount. So if I look at the discount of Milton's got a 3.4% discount to the market. So as I said at the start of the presentation, discounts occur because for every buyer in the market, for every seller in the market, there needs to be a buyer. If there's no one willing to pay up and buy it at NAV, then you're not going to trade it at NAV. Discounts happen because funds don't market their product particularly well. So, if I look at Wilson Asset Management, they are incredible marketers in terms of how they promote their funds, how they talk about their funds, how they go out there and keep the market informed about their funds. WAM is a really good example of that. But it comes down, if I look at the other funds they've got, that's not the be all and end all. Delivering performance, strong performance, is really the key to maintaining a slight discount or premium to NTA. So I think there'll be more things that more listed investment companies, or I hope that they will go out there and do what ALF did and launch big off-market buybacks that close that gap between the NTA or offer shareholders an out in terms of NTA. I think the other thing, there's a lot of other investment opportunities that are out there. So you have an SMA that I spoke about. It gives you a professionally managed portfolio, but you own the underlying securities in that portfolio. It trades at the value of the underlying security. So you can have a professionally managed portfolio that you don't need to look at on a daily basis. That will never trade at a discount to NTA. The fees are probably they're at least on par or better than what you get in a listed investment company. So I think sort of listed investment companies have come out of vogue a little bit. Obviously, ETFs have risen in popularity. So an ETF is sort of just a vanilla index tracking product, low fee, but it tracks the index. So I've shown a lot out there today that have underperformed their relevant indexes over time. So, performance is really key. So unless you either pay for active management and hope to beat benchmark returns or have lower risk than the benchmark, or it's not just about overall returns from the benchmark perspective, but if you're paying active management and getting subpar returns, then you walk out, you sell that thing, and that's why it trades at a discount to NTA. So I would be hopeful that gap does close. Robert writes, why do discounts to NAV arise in the first place? Is it that the fund is under marketed or a function of how often the NAV is published? No, I don't think it's as I said before, Robert, it is a function of how well the fund is managed, but it's also a function of performance and delivering what they say they're going to do. So I note that Watermark recently launched and offered to buy back shares at NAV. I think discussed at MM. Will this become a trend? Why would anyone buy a new fund launch if they can pick it up later at a discount? So when you're buying into a fund, you're backing the manager of the fund. That's the first and foremost, that manager is going to deliver the returns that you can't deliver yourself. So that's why you put your money into a fund. As you made mention of, ALF are doing a pretty aggressive buyback, which we've covered. So I'll leave that one go through to the keeper. John writes, my super fund needs to shift from cash to income producing assets. What part do you think LICs such as Milton Argo, Carlton, etc. play in preserving capital or returning a modest dividend if there is a recession? So thanks, John. So you've looked at those. So Milton Argo, Carlton, etc. They hold underlying shares. In a recession, the share market will likely decline at some point, and therefore they won't be as defensive as you think they are. So it's all around having a composition of funds in the portfolio. So an LIC is just an investment product. It's important to understand the underlying assets. If the underlying assets, for instance, so if we look in terms of Argus, and I'll go and show you the holdings of sorry, not Argus, Argus are property guys, or they were property guys. So if you look at Argo, they're trading a slight discount to NTA. This is a fairly vanilla LIC. So you can see that their positioning is, this is what stock they own. So they own $341 million worth of Westpac. They own $311 million worth of NAB, CSL. So, that's what you own as a holder of the listed investment company. You're buying shares in Argo, and Argo owns shares in all of these companies. So you've got exposure to these companies. So in a recession, then these companies would probably struggle. Banks struggle in recessions, etc. So the LIC is going to track in line with what the underlying securities do. So, you could consider alternative ones. So there are, there's, I wrote last week about XARO, which is a bond fund, which is an active bond fund. That is more, that shoots for lower returns, but is more stable in terms of the capital. It's all around, if I look at our income portfolio in the SMA, it holds we aim to be holding 50% in equities, 50% in income securities. So income securities could be hybrids, they could be MXT, they could be things that have a lower correlation to the underlying stock market, but still produce good income. So it's all around asset allocation. So that's a really broad question that you have asked, and I'm sorry I can't give you a specific answer, but what I would say is that look at the underlying holdings of the LIC and ask yourself, what will happen in a recession? Will those equities decline? I think in that instance they would. This is from Lola, holding money in the bank, not getting any income in retirement. Therefore, I was wondering if an LIC would be the answer as a safe investment to earn a higher rate of interest. something you wouldn't have to keep watching all the time, and one suitable for a self-managed super fund. So without taking into consideration your own circumstances, I'll look, as it is general advice here. An LIC, as I just said before, is about understanding the underlying asset. So if you you can make an investment into a whole range of different products. You could invest in the Market Matters SMA, for instance. That's a portfolio that we manage, that you own the underlying securities. You don't need to look at it every day, but that can go to 50% cash if need be. It can hold inverse correlated funds to protect capital, etc. But an LIC, again, is about understanding the underlying composition of it. If you've got a long-term horizon, many people do, then backing a strong manager in an LIC can often be a good strategy to go by if you don't want to look at it on a daily basis. But you run the risk of getting a Cadence Capital in there that, they've been they're down 40% in the past year or thereabouts, or underperform the market by 40%, which is a pretty big hit. So it's like anything, you've got to back a manager. So you've got to understand the manager's philosophy. You've got to understand how they approach the market, and you've got to be comfortable that they're delivering what they say they're going to deliver. So that comes through as a pretty general theme going across this presentation, just around, at the end of the day, these LICs have a lot of them haven't performed in recent times. So it's been a pretty tough market for performance in recent times, but a lot of these haven't been performing particularly well. If they're not marketed particularly well, then they get a big discount to NAV, and then it's a hard road back for them. So LICs, LITs have a position in our portfolio. So in the Platinum portfolio, they don't, because we believe we're better stock pickers. In the income portfolio, we hold LITs or LICs to get exposure to things that we can't get exposure to directly. So the MXT is an example of that. We can't get exposure to corporate loans. We can't negotiate with the banks and sit up there with the banks delivering on corporate loans in Australia. NBI is another LIT that we hold. That's a global bond fund manager that holds more than 100 global bonds, so we can't get cheap exposure to that ourselves, so we go and hold an LIT in the portfolio to give us that sort of exposure. So LICs, LITs, etc. can hold a really valuable point in your portfolio if they are, if the composition of the portfolio is correct. So I hope that's answered a number of the questions that subscribers had around LICs and LITs. I'll be back with a more standard income note next week. We've just had Jerome Powell speak over in the US, and the market has fallen away as a consequence of that. So an interesting day on the desk again. Thanks for listening. I'll speak to you again. Bye for now.